Now let's look at non-current liabilities. So what are the non-current liabilities? Number one is long-term borrowing. So what does it mean? Loans that you have taken as a business, which you need to pay back to the lenders after a period of 12 months. That is your long-term borrowing. That is your long-term borrowing. Then you got a deferred tax liabilities. Now what is this deferred tax liabilities? Now please remember, as a business, when you invest into new assets, when you invest into new assets, you get more tax depreciation under the Income Tax Act, less tax depreciation under the Companies Act. So because of that, what happens during the initial years, you end up paying lower amount of tax because you got a higher tax depreciation available to you. So since initial years you are going to pay lower amount of tax, but as the time passes, this trend is going to reverse. So in the subsequent years, you are going to pay higher amount of tax because your in the subsequent years, the depreciation under the Companies Act is going to be higher, and the depreciation under the Income Tax Act is going to be lower, and that is why your tax liability are going to be higher in the later part of the life of the machine. So whatever tax that you are able to save today, it will be coming in your balance sheet as deferred tax liability. Deferred tax liability, yani ki this is the tax that you will be paying going forward. So this is also your long-term liabilities. Then you got other long-term liabilities. So remember, the liabilities can happen not only on account of the loan that you take, liabilities can also happen on account of the obligations that you create. So say for example, your company has purchased a plant and equipment from a German supplier, and the contract between you and the German supplier is that you will pay him after 5 years. So suppose that amount is 10 crore. So this 10 crore that you have to pay to the German supplier for the supply of the plant and equipment that they have given to you in the current year will come in your balance sheet as other long-term liabilities. Other long-term liabilities, which means it is other than the borrowing that you may have. The fourth is long-term provisions. So please remember, in the companies, there can be long-term provisions on account of many things. But let me give you a few examples. So your company will has a policy of paying gratuity, or rather it's a statutory requirement. So companies have to pay gratuity to certain eligible employees, but normally companies pay gratuity to everyone. So the gratuity that you pay to the employee is when they leave the company after completing 5 years. Now every year you have to make a provision in your books on account of gratuity. In case if your company has a policy of leave encashment, so obviously the leave encashment will happen when the employee will leave, but then you will have to make a provision for the leave encashment expense every year until the time you really pay it actually. So all those provisions will be part of your long-term provisions, and they are part of long-term provisions because you are making these provisions for the payment that you will be making in the long-term future. So that is your non-current liabilities. If there is any question, please go ahead.